We have a few people coming in. Hi, everyone. This is Marcia Nedlund. We're just going to take a few minutes and let people enter the webinar. But it would be great if, as you're entering, you could type into the chat where you're from. I'll start. Jackson. Okay. Oh, hi. Oh, wait. Oh, it's David. David Hunter. Okay. Chris Siglin's name, but hey, Michelle from Memphis. Gainesville, Georgia is not a city I'm familiar with, and I've worked in Georgia some. Fort Lauderdale, great. Hi, Justine. Give me another landmark for Gainesville, Georgia. Robin from St. Louis. Hey, Robin. Austin. Aldo. Oh, northeast of Atlanta. Okay. Well, then it's just, a commuter town, right, to Atlanta these days. Sanford, Maine. I'm always intrigued when we have anyone from Maine. Hey, Jack. Jack from Cleveland. Jack has done some of our webinars before, at one webinar before, I think. Hi, Donnie. Donnie, what organization are you with in Chicago? If you are with one. We don't know. Okay. Volunteer. Okay. Even better. Lake Lanier for tourism. This is in Gainesville. Great hospital. Oh. Retirees. Okay, well, I think I'll get started since, we have a few more people coming in, but I'm going to start with a couple of slides that have to do with just background on middle neighborhoods. So, whoops. Oh, yes, that's fine. But actually go back. So today's session is about using mortgage refinance as a tool for stabilizing middle neighborhoods. And we are very fortunate to have people from two organizations that are CDFIs that actually either originate the mortgages themselves, or they have persuaded, in one case, other banks to originate the mortgages, and they just buy the mortgages from them. So they're almost act as a secondary market. But we'll get into all that. So the Middle Neighborhoods Initiative is what is sponsoring this webinar. We're a national initiative focused on mobilizing attention around middle neighborhoods, which most people think are just fine and don't need much assistance. But in fact, if you look at their trends over time, we have noticed that they're disappearing in a lot of cities, either through gentrification or through further decline. We have a community practice that's specifically what's sponsoring this webinar today. We facilitate peer-to-peer learning, and we have about 800 practitioners, policymakers, and researchers. And we definitely encourage you, if you're not a member of our community practice, to join us. You can go to middleneighborhoods.org, and at the bottom of any web page, you can sign up to be a member of the community of practice and or get our newsletter. We do some research into topics relevant to middle neighborhoods. We have targeted that research over the last couple of years into Black middle neighborhoods, and have really learned a lot, and has caused us to start to put together actually we're the finishing touches of putting together a proposal that we're going to shop around for funding that would actually funnel some grant funds to practitioners in Black middle neighborhoods and really figure out what is different about the sort of theory of change about improving and stabilizing middle neighborhoods when they're Black middle neighborhoods and have the additional burden of, past racist housing policy. So we do policy analysis and advocacy through NCST, and the whole shebang is a partnership between NCST and NeighborWorks America. NeighborWorks America sponsors the community of practice. So when we talk about middle neighborhoods, we're mainly, not talking about a specific particular demographic, but generally we understand that these neighborhoods were built largely for families with children after the war and the last war, and were mostly single family homes. They still tend to be more than 50% owner occupied. They probably were nearly 100% when they were built. So if you watch them close over time, that owner occupancy rate tends to be eroding. The housing stock is aging, though it's still in pretty good condition. The problem is that it often lacks the features and updates that would compete well for today's home buyers, unless we're in the last year or two when home buyers are willing to take a lot less than their ideal because of the pressure on the market. One of the things that we find really interesting about middle neighborhoods is that they tend to be more racially, ethnically, and economically diverse than either their lower income or higher income counterparts. The reasons that we're concerned about them is that they are in many, many cases faltering in their sustainability. And by sustainability, we mean things like their ability to reliably attract a replacement owner occupant instead of a landlord or investor who may not be a good one for the neighborhood, to generate home values that support quality maintenance, repairs, and updates in the case of weaker markets. Again, repelling irresponsible investors. It used to be easy for them to do that. It's not so easy now. And maintaining engaged residents as there is, turnover and change in these neighborhoods. The long-term relationships among neighbors, are getting broken. And finally, just to deliver home equity to owners, this is the place where we help people to become first-time buyers. And part of the reason that everybody's excited about first-time home buyers is not only for their impact on the neighborhood, but also because home ownership, we believe, is a opening to develop household wealth. If the market's not there to help them do that, then we failed in that part of our mission. Now, some middle neighborhoods are facing gentrification and displacement. And certainly in the last 2 years, I think we're all still waiting to see how this is going to play out over the next few years. It's been a complete market change for many, many neighborhoods, and even regions with strong economies for sure, but regions with weaker economies are finding that they're losing affordable housing as investors and second home buyers and people just moving out of cities are buying up additional property. So we really think it's an opportunity to intervene now and ensure that existing residents and businesses share in the prosperity that's hitting these markets now and preserving the affordable housing before it's lost. I wanted to draw your attention to one tool on our website, which is a mapping tool. You can either just go to middleneighborhoods.org and look in the top navigation bar, and there'll be something called maps, I think, and you can get to it that way, or you can go directly with this address. Basically, it allows you to type in the top right your MSA, and then choose a tool on the left-hand side, either one of two time periods, and then you could choose a city, national, or regional household median income. in different ranges. And you can just see which census tracts in your MSA pop out as meeting those criteria. It's really a blunt first look to use household income as the determining factor for what's a middle neighborhood, but it can get a conversation started to really think that through and to perhaps, give you an idea of where you might want to dig a little deeper and check on how your middle neighborhoods are doing. So today we have two guests. We have Elena Gonzalez, who's the Senior Director for Policy and Resource Development at HomeWise. She's based out of their Albuquerque office. Many people may know HomeWise for being headquartered in Santa Fe, so they work in both places now. And Stephen Meyer, who's the CEO of Renew Indianapolis, obviously in Indianapolis, Indiana. An organization, in both cases, they are CDFIs, and they do a variety of work around protecting and developing affordable housing, as well as place-based work around stabilizing and growing neighborhoods. We're going to talk about each of their scenarios and what they're doing, and then we'll have a Q&A period, but please do feel free to type in questions into the chat or into the Q&A on this webinar menu at the bottom of your screen. And some of them might be able to be answered along the way. So I'm going to turn it over to Elena now, who is going to share with us how HomeWise uses Refinance as a stabilization tool in their service area. And that's such a great house, Elena.
Thank you, Marcia. Thank you for having me. Yes, I'm Elena Gonzalez. I've been with HomeWise for almost 8 years now. And thank you, Marcia. The introductory slide has one of our homes. As many of you know, we are a large CDFI, and we do housing development, and we also do acquisition rehab and buy vacant abandoned properties and rehab those as well, and sell those. But on the next slide, we have our kind of our mission that we've stood by for over 30 years. And as Marcia said, we started in Santa Fe about 37 years ago and opened a branch here in Albuquerque about 10 years ago. So we really, at the core of why we exist, we want to help create successful homeowners. And we added recently and strengthen neighborhoods so that individuals and families can improve their long-term financial well-being and quality of life. And as Marcia mentioned, when we opened up in Albuquerque and really put our roots down in more of a disinvested neighborhood, as a matter of fact, called the Borellis neighborhood. And behind my big head here is actually a picture of our building. We put our roots down. We bought a really fantastic building, almost 100 years old, and renovated that. It also has 19 affordable apartments. And the neighborhood, I have very close ties. I'm born and raised in Albuquerque and had family ties to this neighborhood from decades ago. So it's very near and dear to my heart. And we also, a few years ago, decided to take a holistic approach to neighborhoods and what it really means to strengthen neighborhoods. And we started a very participatory planning approach and listening to residents and what they needed, as far as we got everything from, we need affordable daycare and access to healthy food, and of course affordable housing and resources to be able to put our roots down and buy a house here in this neighborhood. And so we've been doing that for a few years, and it's been such an incredible journey. And when Marcia and Ann talked to me about the Middle Neighborhood Initiative and what we do as far as lending and helping people buy homes, and we started talking about refinancing, and I want to give you some specific examples and kind of our angle to add to this conversation today. So the next slide has a few bullet points that I want to talk about today and why as a CDFI and being a mortgage lender is such an important thing right now. And if you're able to offer refinance opportunities in your community, it's really important, especially here in some of our middle neighborhoods in the southwest quadrant of Albuquerque. Albuquerque's pretty easy. We have 2 main highways and we're broken up into 4 quadrants. And the west side of town has a lot of middle neighborhoods, of which I live in one and grew up, you know, just down the street from where I own a house now. And when we started working and really addressing different aspects of really home preservation, we decided to look at refinance as an initiative to help people in our community who had been taken advantage of and bought a house on a real estate contract. So that's what I'm going to talk about this morning or this afternoon for those of you on the East Coast. It became very clear to us as we started working in this kind of arena is how do we reach folks who bought a house with alternative financing, and here in New Mexico, it's called a real estate contract. And in many of those instances, we have seen that those real estate contracts really walk a very fine line on being predatory. And I say that because we have seen so many of them. And so I think what happens in many communities is that it also has a racial aspect. Here in Albuquerque, we see so many individuals and families who are Hispanic, mostly Spanish speaking, many of them who might have an ITIN number, individual taxpayer ID number, instead of a social security number. They feel maybe in many cases hopeless, thinking they want to buy a house, they want to put down their roots as well, and they don't think they can qualify for a safe mortgage. And so we have a lot of families who are on these real estate contracts, and contrary to popular belief, many of them don't understand the terms and conditions of that contract, right? We've seen terms with balloon payments as short as like a 2-year time span. The most common is 3 to 5 years. And what I mean by that is you buy a house on a real estate contract, it's owner to owner financing. Many times you are looking at a higher down payment than you would be on a regular mortgage. We've seen $10,000, $20,000, $30,000 down on some of these short terms, balloon payments, high interest rates. And we're seeing it mostly in our Hispanic, Spanish speaking communities in some of these middle neighborhoods. It's very prevalent. And so those families, once we are engaging with the community, and that is the most important aspect of what we've been doing, is what are the strategic partnerships we can build to reach these underserved families and neighborhoods in a way that we can build trust, because I think a lot of these families have a mistrust of banks and mortgage companies. And if they have an ITIN number instead of a social security number, there's a whole layer of fear there as well. And then the language barrier. We have yet to ever see a real estate contract that's written in their native language, in most cases Spanish, right? And so it's really no wonder that these families have been taken advantage of. And, you know, I'm working on policies, but we don't have policies in New Mexico where these buyers have many rights. And so what we saw was, you know, families being displaced out of their house if they became delinquent on their real estate contract. And in many cases, you can miss like one payment. You should read some of these contracts. One payment, 2 payments, and then it turns into our tenant landlord laws here, you know, in our community, and it ends up in an eviction. And so there's not a lot of legal recourse or protection for these families. And so we decided we we really need to be proactive in building these partnerships and reaching these families before it's too late. And so we're doing the financial fitness education, home buyer education, the one-on-one really intense work it takes to make sure that these families get approved for a safe 30-year mortgage. And I think on my next slide, and not very in depth, but we really look at this as an anti-displacement strategy, because we're really good with most CDFIs that are homeownership focused in helping people buy a home to create family wealth, and especially now addressing the racial wealth gap in our communities, right? And we're gung-ho about that. But the other side of the coin is preservation of the physical home with home repair programs, but preserving the family wealth and asset. And when you buy a house here in New Mexico on a real estate contract, you're buying the house. It will become your asset when you pay it off, just like a mortgage, if it's written with reasonable terms. But as we mentioned, so many of them are predatory. So if we can reach these families, and we're using refinance as a tool to help the family save their wealth and save their home from an easy, practically overnight foreclosure and eviction process. And we've been very fortunate. We have offered portfolio financing for our borrowers with an ITIN number instead of a social security number, but we also partner with Self-Help Credit Union, which, they are very well known. They're very passionate about this, in helping immigrant families buy homes and have an equal opportunity to a safe 30-year fixed mortgage. These are families that have been working hard, put down their roots, paying their taxes, so let's work with this population and use this refinance tool to help them save their home and protect their wealth. So it's huge for us here. We have several ways of kind of researching, and most of them have been in all these middle neighborhoods on the west side of Albuquerque, and especially in the southwest quadrant. It's a concentration. There's a very high rate of Hispanic homeowners that live in these neighborhoods. And I think, there's probably investors or realtors or whoever it is, kind of targeting this population with real estate contracts. And so the more we can be in front of this and be proactive about it, I think we can really move the needle in helping some of these families. And so I just encourage this strategy for any CDFI that does mortgage lending to pay attention to this. And whatever's in your community, it may be a real estate contract, it might be a lease to own, or any other alternative financing that is not favorable to the borrower. It is looking at whatever tools that you have in your toolbox to help these families refinance and save their home and their family wealth. And even if they did put $20,000 or $30,000 down, that is also gone. They lose that. They don't write real estate contracts to say, oh, well, if you ever miss a payment, you get all your money back. It doesn't work that way. And during the last 2 years, during the COVID pandemic, we have seen families struggle. And we started an emergency mortgage assistance fund right away in March of 2020 when this happened. And I tell you what, one of our target populations were people with ITIN numbers that maybe they were not eligible for all the federal stimulus help. And so we did see that we were able to make a dent and save some of those homes with that. But as a CDFI, I just feel blessed that we have this flexibility to adapt to situations like this and use our mortgage and refinance tools to help people and save their home and their family wealth. So I'm interested in Stephen and how you're using this tool as well in your area. So I think that was all I had this morning. I think the last slide just gives contact information. That was the building I was talking about where I am sitting now. That's our home office in Albuquerque. There's some contact information. I'm sure the team can send out these slides. I have our community engagement manager listed on there, Miss Nina Cooper, who's been with us about 6 months, and she's really taking this initiative to the next level. So we're happy to participate in this, and Marcia will keep you posted a couple times a year to see how this initiative is really working for us here in New Mexico. Thank you so much.
Yeah, it's really interesting. I'm still a little like I stumbled into the fact that there is a lot of this kind of real estate contract in Albuquerque because I was working with your team who works on the neighborhood strategy in the Borellis neighborhood. And they were saying that if I understood this right, that these seller finance deals still involve realtors a lot of the time.
Sometimes they do.
Which
Yes.
is so curious to me. My experience back east with land contracts is, it was very often about a landlord who was renting to someone and said, "Oh yeah, I'll sell you this property on a land contract," and there wasn't really much else involved. So I thought that was interesting. So in other words, they could tell by looking at MLS data and stating the source of funds that a lot of these transactions were real estate contracts.
Yes, and actually that's where we get a lot of the data in our multiple listing service, and they're required to state the method of sale of financing. I'm sorry, and we do have, it's a drop down. That's a choice on the real estate contract, so we can actually see
so interesting
the trend and how it is still happening. And so we're trying to really get in front of that. But it's good data to see, to study.
And so it sounds to me like you originate some of the refi mortgages, and you mentioned that they're portfolio products for you, so you're not selling them right away, at least.
Correct.
Or perhaps ever, if it's an ITIN, if it's a household with an ITIN number?
Well, we do both. We keep and service all of our portfolio loans, and then self-help, that's our secondary mortgage
Self-help
market.
is your
So they
secondary
will buy those mortgages. So obviously
Gotcha.
that's our stream of capital to do
Okay.
that. But on some of them, if they're non-traditional or they don't meet all those guidelines, we definitely keep those in portfolio. And the beautiful part of what we do as a mortgage lender is that we're also a mortgage servicer. So we retain the servicing to all of our loans. And I think that's a long-term success strategy for a CDFI who is in this, who works in this arena. It's almost like this client for life. And so we can do early delinquency intervention as well and get back in there with our home purchase advisors to work with the family and kind of cut that off at the pass so they will not become seriously delinquent or foreclosure. We service probably over 7,000 different loans, and our delinquency rate is 1.37, which is well below FHA, conventional, VA, everything out there. So I just think it's the hands-on approach, the pre-purchase counseling, and just building that trust in the community. And then they come to us if they're in trouble.
I said I was going to save Q&A till the end, but since we have, so you were very concise in your presentation. We have a question here about whether or not HomeWise works with homeowners or heirs losing their home due to reverse mortgages. Do you ever do you ever find situations where there are reverse mortgages on the property, and how is that?
We do, and right before I came to HomeWise, I did a 3-year, I ran another nonprofit. I had a 3-year contract with our Attorney General's office, and yes, that was a big deal. People losing their homes who had reverse mortgages, and it really was for non-payment of taxes. And trying to save those
taxes.
homes.
Okay.
And so we offer that counseling. We have a couple of people in-house that have that knowledge. They worked with me previously. So we kind of take those on a case-by-case basis, but there's a really active nonprofit in our community, and they have attorneys as well. And so they're a great partner working on that initiative. So hopefully we won't see any type of foreclosure crisis like after we saw after the Great Recession. And so yeah, trying to, and my prediction is that we won't, because so many resources were flowing into the community as far as emergency mortgage assistance funds. And that's the biggest difference between after what happened 2007, 8, 9, 10. We were struggling to help families. There was no cash assistance. And so this time I think is so drastically different that fingers crossed we won't see a wave of foreclosures after the effects of the pandemic.
And Robin, who posed that question about reverse mortgages, why don't we pick that up again after Stephen has done his presentation and dig in a little deeper your question, because I'm not sure I accurately described what it is that you're concerned about. So we'll come back to that. So thanks so much, Elena. And why don't we switch over to Stephen now? And he is going to click his own slides because he likes to go at high speed.
I have control issues.
Okay.
I really just want to spend this time peppering Elena with questions, because I-10 is one of the things on my to-do list. So we haven't been able to do that yet. But similar situation while I'm sharing my screen here. We acquired a property in a redlined area, and we paid cash for it. And when we went to do the quiet title, it had been sold on contract so many times because it was in a redlined area over the years, that there were over 100 people that had to be given notice. It cost, we spent $30,000 on the property. We spent $40,000 on the quiet title action. So,
and that's because it had flipped so many times. There were so many people who had land contracts or real estate.
So it's kind of it's the flip side of, what's happening now. It's the historic issues that were related to all these barriers to home ownership. So anyway, I'm Stephen Meyer, and I work for Renew Indianapolis, except I don't work for Renew Indianapolis because we're in the middle of a rebrand, and we've legally changed our name. So it's not public yet, but we are now Intend Indiana. And we did that because we have 4 main initiatives, and it was getting confusing to people about what exactly we were doing and where we were doing it. And so in an effort to be more transparent, we're putting our initiatives more forward facing. So we run the land bank for the city of Indianapolis. We develop single family houses for home ownership under our Home Matters program. And then we have 2 CDFIs. Build Fund does small business lending, and then Edge Fund does affordable housing lending. We do both single family and multifamily lending under Edge Fund. So
Stephen, do you realize that we're seeing your screen that has also your next slide on it? I don't think you're directly running the
oh, really? Well,
slideshow.
It shows us just the slideshow on my screen.
Oh, it does? Oh, really? Okay.
Yeah.
Well, then we'll carry on.
Is it distracting for you?
Well, I'm sure we'll get used to it.
So, well, okay. Well, we'll just burn through this, and I apologize.
No, that's okay.
So we started looking at mortgage refinances as we started doing some work, some place-based work, and we are not a place-based organization, so we support other place-based organizations. We bring the resources we have under our umbrella, but we partner with a lot of community-based organizations. And so what we were seeing, and this is just a couple of examples of an area where we were doing work, the overlap between vacant property as it existed, redlining, and race were so prevalent that we started really focusing on these areas that had good housing stock, but were also like historically disadvantaged. So one of the things that we noticed in this particular area that I just showed you was that after the last recession, 2008, the home ownership rate for Black homeowners dropped pretty precipitously, especially as compared to white, Asian, and Hispanic homeowners. So we at the time had been really focused on new home ownership, as Elena said, new mortgages for new homeowners, building houses, rehabbing houses for new homeowners. And we hadn't really spent any time thinking about how we preserve home ownership. And these numbers in that majority Black neighborhood, they lost about 30% of their homeowners in that decade after the last recession. So as we started to see this information, we started to think about what we could do to address that particular issue. And you can see, 46218 is the area code in question, but they lost 30% of their homeowners in less than a decade. So so that's kind of why we started thinking about this. And then when the pandemic hit, we were really concerned about the loss of Black homeowners that were going to be disproportionately affected by COVID. And so we came up with this program, which we had not been doing any refinances prior to COVID. So we kind of came up with a sister program to the rental assistance program that the city was supporting, and the mortgage relief program that the state was running. And we were trying to figure out, how do we help people who were temporarily out of work because of COVID, maybe missed a few payments, but needed to be caught up on their mortgage. So we came up with this program we called the Indie AMP, which is affordable modification program, because we like to have clever names for everything we do. So we originally came up with this program as a way to spend CARES Act funding, but it turned out we didn't use it. But it was focused on current Indianapolis homeowners. It had to be their primary residence. They had to have existing mortgage debt. And then they had to fill out a certification saying that they were negatively affected by COVID. So we basically threw together this program pretty quickly. It took us about 6 months from when we conceived of the idea to when we started making mortgages. So we started with the Home Ready program as our baseline. So we are not a mortgage lender. So unlike Elena's organization, we don't originate our own mortgages. We do originate loans for other programs, but not mortgages. So we have bank partners that do this. And so we started with the Home Ready underwriting guidance, and then just created exceptions and overlays to that underwriting guidance, so that the bank partners that are doing the underwriting and origination could essentially use Home Ready or underwrite to Home Ready and originate our loans for us. So we decided on a fixed 3% interest rate. We didn't have, the first round, we didn't have any income restrictions on who would be eligible. We didn't know how many people we were going to have interested in this, but we did decide to limit the mortgage debt to $200,000. So we were hoping to get the lower income folks by focusing on the mortgage debt amount. And then our total debt to income ratio, unlike Home Ready, we went up to 44%. And then when you refinanced with us, you didn't make your first payment for 90 days. So it gave folks 3 months to get caught up on all of their other bills that weren't part of their mortgage, and get on a more stable footing, financial footing. And then on the exception side of Home Ready, we just had a floor of credit score of 600. You had to have been current on your mortgage essentially before COVID. That was a CARES Act issue. And then we didn't require any appraisals. Our parent company is a brokerage, so we did basically brokers' opinions on the value and went up to 95% loan to value. That helped us speed through getting the loans closed as quickly as possible. And then we came up with some alternative ways to verify income. Since people were out of work or had reduced wages, we were able to annualize their income based on their 30 days most recent pay stubs, instead of looking back over 2 years. So some issues that we thought through with our bank partners as we were putting this together. So there were basically 4 different kinds of partners that we put together in this program. Renew, which is now Intend, which is our parent company. Edge Fund, which is our CDFI that does affordable housing lending. We administered the program. We got a $3 million grant from the city of Indianapolis. And then we hold the paper for all of these mortgages as well under Edge Fund. We have an outreach partner called Kepra Institute. They're very grassroots. They're involved in a lot of other non-housing related outreach programs. They're very connected to the neighborhood. So they marketed the program. They assisted people filling out their application. Everything was done online because of COVID. So especially lower income people needed some help. So their staff managed all of that navigation services for people, as well as the outreach. We had some senior debt because we had the CARES Act money was very weird. And so we had to borrow money, pay back money to make it eligible, but that's federal regulations. So Wood Forest Bank lent us $5 million so that we would be able to spend the money. And then we have 2 partners on our lending side. So Merchants Bank of Indiana and Stockyards Bank underwrote and originated all the loans for us. So, and they did it for free. So we would gather all the information, all the application information, go through it, make sure it was complete, make sure they income qualified, and had everything that that we thought would be necessary. And then we turned the file over to the bank partners to do the underwriting, and then they originated the loans for us. And then they sold the loans back to us at par value. So we just bought the paper, usually on the same day that it was originated. So we hold all the paper. And then Merchants Bank also is doing all of our servicing for us. So they, again, do this essentially for free for us. It's a very, very small fee, but so all of the loans that were sold to us, they retain the servicing rights. And then when the ones that Stockyards originated, they sold us the loan and gave the servicing rights to Merchants Bank. So it was a lot to coordinate, let's put it that way. And then all the money just gets recycled. It's how CDFIs work. So in 1 year, then we reached out to 50,000 households. Again, this was during the pandemic, so we couldn't have in-person meetings. So we knew that the outreach was going to have to be huge compared to how many loans we were going to make. So we ended up closing in the first year, actually it was 20 loans in 13 zip codes, about $3 million. But the really exciting thing, I think, is the bottom bullet point, which is on average, and this goes back to Elena's point, the savings to the borrowers was on average $175 a month. And that's huge for low-income families. And when you think about a 30-year mortgage, saving $175 a month, that's $60,000 in savings just by refinancing. And I think this has been one of the challenges talking about this is grants are easy to understand, but low interest loans are more difficult for people to understand, but they can have the exact same impact on people's lives. And the money can be repaid and reinvested into future loans. So we did an evaluation at the end. This is something I always talk about. There's two different kinds of feedback. One is corrective and improves. The other is just amplifying and distorting certain voices. So you have to be very careful about, are you getting valuable feedback or not valuable feedback? So we reached out to every single one of our borrowers, a bunch of people who didn't make it through the process, some of our other partners, and all of our bank partners to get feedback on the program to see what we could do to improve it. Because we did decide to keep this going even past COVID. So, and as Elena said, it's really an anti-displacement program for us long term. So we did make some pretty important changes. The biggest one being that we allowed people to include non-mortgage debt into their refinance if it helped them qualify. So if their total debt to income ratio was like 50% and they needed to get down to 44, we would refinance their credit card debt in order to get them down and qualify. So that was really important. And we also did raise the total debt to income ratio. It was originally 43, we went up to 44. And we may actually go higher than that going forward. And then the next area where we're rolling this out is more of a middle neighborhood than where the original loans were. And you can see here, these are some, this is a study we had done for an area on the Far East Side. And there's some very high owner occupied areas and low cost of housing for Indianapolis. But when you look at what their payments are, these numbers in the census tracts are what their savings would be annually if they had market rate loans. So on average, the homeowners in some of these neighborhoods are paying $3,000, $4,000, $5,000 too much in their mortgages. So this is where we're going to be focusing over the next couple of years, this particular area for sure, but also these types of neighborhoods that have high home ownership rates, making sure we preserve them and lowering their cost of housing so that they can build wealth and be stable in their housing.
Okay.
So that's us.
How did you get the data on the mortgage savings is it HMDA data?
Yeah. We pulled all kinds of data. We have access to our MLS information since we're a brokerage. We have bank partners who pulled information for us as well. And
that makes sense.
So we were kind of layering as much data as we could onto certain geographies that were also geographies where people wanted to live. So we're trying to focus more on areas of opportunity rather than just areas where we knew we could build affordable housing.
Well, it's such an interesting, that particular metric of how much would a person save annually in their mortgage payments if they had a market rate loan. That's so fascinating. and to be able to apply that to different census tracts to see, you know, where the opportunities are to be of greatest help. Very
Yeah,
interesting.
and that those averages were for the whole census tract. I mean, if you think about the whole census tract is paying $5,000 too much a year on their mortgage. It's a lot of predatory lending. It's a lot of yeah.
Yeah, very interesting. Okay, we're definitely going to open this up for Q&A. I will, oh, there we go. Megan was asking sort of the same question I was. So I'm assuming, Megan, that you were asking about that particular last map he showed. Maybe you could pull it up again, Stephen.
Maybe I can. Yes.
Okay. Maybe, yeah, I know.
And Stephen, does that data show, like, I don't know what's, you know, the alternative financing, like I talked about the real estate contracts, does that data show those type of homeowners or just traditional mortgage financing?
So that's a good question. I'd have to go back and look and see what exactly it includes, because I know it includes non-traditional financing of several different kinds. So I'll have to go back to that report and see exactly where.
Maybe we need
what
another
sources.
webinar at some point of just some of these. No, I'm serious about, I mean, I'm really into data. So, you know, how to put together the numbers to assess things like what's the rate of alternative financing in different census tracts, and what is the extra amount of mortgage payments that people could otherwise not be making, you know, because those, I know if you happen to have cooperative lenders that will share data with you about, you know, all the loans they have on the books in a place that's very different than if you're trying to do it somewhere else. Chris, is that really you, Chris, or is that David from NCST? There's a question here. Stephen, based on the success of your refi program and decision to expand it, does your CDFI status enable you to tap the additional lending capital you need? Oh, that is from David. Okay.
Yeah, so in theory, non-CDFIs could do what we do. So really, mostly what we're doing is buying paper, but the CDFI status does allow us to work with banks. They're willing to do this for us for free because they get CRA credit for working with a CDFI. They get CRA credit for originating the loans for us. They get CDFI credit for serving on our boards and committees and providing technical assistance. So that doesn't necessarily translate to other forms of nonprofits. However, if you remove all of those things, if you have a bank partner that's willing to do it, you know, honestly, I just ask, and the worst they can say is no. And the 3 banks, I only approached 3 banks. All 3 of them said yes. I had 3 specific asks for each one, specific ask for each one. They all said yes. So you know, don't think that just because it's the way it's always been done, that it has to be done that way going forward. And then Elena brought up owner-occupied repair, which I think is really important. We don't do it. It's a faltering program generally in Indianapolis. But you know, as you're thinking about place-based redevelopment work, and we're doing some of that in 2 focused areas. We like to come in and our initial intervention into a neighborhood is owner-occupied repair with a partner and refinance with us. So you can help the people who are already living there first, then do the other things that you want to do. You know, if you want to build new houses, bring new rental opportunities in, but being able to offer something to the existing residents before all of that other stuff happens is incredibly valuable.
That makes a lot of sense to me for a variety of reasons, and certainly in the kind of markets we're in today. Okay, I don't want to ignore the question from Barfield about, but I think it's a question that's kind of outside the scope of this conversation, Barfield, about assistance to heirs of property who need rehab. That would definitely be a local thing. And you should, I mean, the first thing I would do is contact probably your city council office or your nephew's city council office and just try and ask them, what programs are there either at the city or through a nonprofit to assist people with rehab work on their homes. And if there is an heir issue, like if your nephew isn't yet on the title, that can be a whole other can of worms. And so that in that case, you may need an attorney actually to work that out before your nephew would be eligible to get financing or a grant to repair that home. So let's go on to Megan has a question. She sees the White House is considering reviving Title I repair loans. Have you heard of or looked into that program at all? So one of you describe what a Title I is. I think I know what it is, but it's been a while since I thought about it.
I'm not well versed in that.
You're not a lender, really. Your particular staff position isn't lending. This sounds exactly like something you should know, Stephen, being a lawyer and who named something Title I. I don't know.
Yeah, that does sound like something I should have in my knowledge bank, but unfortunately is not.
Okay,
So.
Megan, can we unmute Megan and have her tell us a little bit more? I feel like, yeah, we're getting close to the end of our session here, or I go look it up. I have this vague sense that it's like
Yeah, I can. Can you
Oh.
hear me?
Yeah.
Okay. So I happened to come across this on HUD's website a while back, and actually reached out to our Richmond. I'm in Norfolk, Virginia, our regional office, to get more information. And I guess the program has been dead for quite some time, even though it technically exists on statute. But it's essentially a home repair program that's funded by the federal government. So lenders would have to agree to review periodically the contractor invoices and do the inspections. It's sort of like allowing bank institutions and CDFIs to run rehab programs through their program. And there's a partial grant component, so you could get up to $7,500 as a grant, with the rest being a loan, low interest loan.
Okay, I got
interesting concept, but
I pulled it up. It's an FHA Title I loan. That's, yeah, you're doing a better job at putting some detail on what I thought it was. So one of the things that's interesting, has always been interesting to me about it, is that I think it does not require an appraisal. So it doesn't care how much out over the after rehab appraised value you are, which could be a problem, assuming I'm correct about this. You want to have some protection for the borrower, but in places where appraisal gaps are a real problem. So I'm just looking at one bank's marketing of this loan. So it's one of those products where it's up to local financial institutions to decide to take it up and actually do it. You can't, FHA will insure it for them, I think is the idea here.
Yeah, so this has always been one of the challenges of using federal money for owner-occupied repair,
Yes.
because the administrative costs for the program don't cover the administrative burden that goes with the program. And so, being able to roll some repairs into a mortgage would be really great, because a lot of people are paying too much for their mortgage anyway. And if you could do cash out refinances to allow them to do the repairs on their house, instead of, here, at least the way we do it, like the city would be involved in like deciding what's okay to be done to the house. So yeah, I think this is really interesting.
Well, I'm really glad you brought it up, Megan, because if it's, perhaps they're going to start really promoting it to local financial institutions and trying to get them to actually use, create the product and use it. That would be really nice, because it's been something that actually in middle neighborhoods, it's been brought up more than once among our sort of leadership group. But again, you have to talk to some local lender into actually using the product. But by the way, that's another thing I wanted to mention, Stephen. I think all of the 3 lenders that you're working with on your product are community banks. Is that right?
They're all smaller, medium-sized banks. Yeah.
Yeah.
I mean, it's much easier. I mean, yeah.
Yeah.
If you need to borrow money, you can go to a big bank. But if you want to work with somebody, I would recommend not going to a big bank.
Yeah.
And I also wanted to
Go ahead.
underscore something Elena said that I think is really important. We do hold everything in portfolio too. And, I see it as just like, buying and investing in property. Owning a mortgage in a neighborhood is just as much investing in a neighborhood
Yes.
as something else. So, and I think that's how we need to think about it. And, I am a lawyer. I try to think like a lawyer while I'm doing community development work, which is always a challenge. But, we have a sister company that's a real estate company. So we don't charge PMI on our mortgages, partially because if somebody loses their job, gets sick, can't, and just can't possibly make their mortgage payments anymore, we can do a deed in lieu of foreclosure and just, get them out of that mortgage as a soft exit. And so having that flexibility, being a real estate company as well as a lender, and using that relationship to help people, even if it's not necessarily an outcome that they want to have happen, but it's, when you're faced with either bankruptcy or foreclosure, or here, we'll just buy it from you and give you a soft exit.
You can have a fresh start.
Yeah.
Yeah. Well, this has been a very interesting conversation. I'm willing to go forward for a little time if our speakers are, but I wanted to acknowledge that we said this webinar would end about now. And so for those of you who need to take off, just please do remember to go join us at middleneighborhoods.org. And email me if there are topics that you wish we would cover in a webinar, or topics that follow-ups to this webinar. It's Marcia@middleneighborhoods.org. Marcia, MARCIA. I'd love to hear from you. So, I don't know, Stephen and Elena, do you have 10 more minutes? Yeah, okay. So on the community banks question, possibly I've mentioned this to you, but my personal experience of observing which banks invest in neighborhoods, who seem to have a willingness to be flexible about creating perhaps a new product that they'll keep in portfolio for a while, it's usually community banks. And I don't have the background, to understand why community banks are different than national banks, why they have that flexibility. Perhaps they have a completely different charter, or, it's something different about their regulatory requirements. Do you happen to know the answer to that, Stephen?
I can speculate wildly about it.
Okay. Well, if anyone out there in our group does know more about it, I mean, I thought it was interesting that April put up, she's with FDIC, and I think OCC regulates community banks. So it's crossed my mind to reach out to OCC. I'm trying to put together a webinar just about the idea that, we need more capital in our middle neighborhoods, and probably we're going to have more success approaching community banks about, doing something a little creative to extend more capital and credit into our neighborhoods than we would be national banks. And that's assuming that you're not a CDFI and can't do it yourself.
So I'll
Um,
say two things. One is I think the bigger banks really rely more heavily on construction loans for tax credit projects and buying tax credits as part of their CRA strategy, more so than doing like really community level lending. And so I just don't think it's really in their wheelhouse to do um, community level lending. But the other thing is that um, in order for banks to really be able to rely on um, a, CDFI or a nonprofit partner for part of their CRA requirements, one is that they have to, include that activity in their plan. So you have to be able to have a relationship with a bank that they can include you as part of their CRA or what you're planning on doing. It doesn't necessarily have to list you individually, but include that activity in their CRA plan. And then two, and I think this is the most important part, is you have to be able to reliably deliver that for them because they have to do it every year. And so if you're going to partner with them and be a partner on delivering their CRA requirements, you better do it, because otherwise they're going to go find somebody else who can do it for them. So yeah, it's
Elena, I wanted to circle back to you about the I-10 borrowers. And I've lost track over the years of which, if any, secondary markets will buy mortgages made to borrowers with I-10 numbers. Is it no one, and that's why you work with self-help, or?
Right, I think so. Self-help is probably the biggest player in that arena, and so yeah, they've been so great and flexible with us. So when we renew our contract, we can talk about guidelines and kind of what's going on locally, and have a real concrete say in how those underwriting guidelines are written. And it's been very successful. Actually, our I-10 borrowers are the lowest delinquency we have, 0 defaults, and they prepay their principal more than our Fannie Mae loans. And so they're super high performing. And as Stephen said, I mean, the biggest benefit of refinancing into those loans is they are saving so much money, and interest in that, obviously, in the long term, builds family wealth much quicker. So I don't know. There are credit unions. I think there's a local credit union, and I don't know if they're selling theirs on the secondary mortgage market. There's 2 credit unions in New Mexico that do have 30-year fixed rate mortgages for I-10 borrowers, much higher down payment and stricter guidelines from what we've noticed. And so yeah, it's just kind of a matter of building that trust with those communities.
Yeah. Well, if nothing else, I think one of the things that we can probably do a better job of carrying forth from one community to the next is the experience that you guys have on your portfolios in terms of loan performance. I mean, once you call out those numbers, they're always better. I've never heard of an I-10 loan portfolio that didn't perform way better than any of the national ones. And also on the whole issue of just doing your own servicing, that always seems to make such a huge difference in loan performance as well. Stephen, do you do any servicing?
No, we don't. Yeah, we are typically the seller on a lot of our houses that we're financing as well. So
gotcha.
outside of the refinances, we have a very close relationship with most of our borrowers. So
yeah.
And they all know, like, even though they're writing their check every month to Merchants Bank, they all know that we own their mortgage. So
that's good. Okay.
Yeah.
Okay.
And we include them like in outreach, even after they've closed their loan, like they're added to our distribution list, our email, like
they're part of the family.
They're part of the,
I think that's a great way to do it. Well, I feel a responsibility to pull us to a close, even though I could talk to the two of you forever. I really want to thank you. I think you have illuminated for me a whole potential plank of our work that needs to start just being incorporated from the beginning into planning that we do around place-based work. I love the idea of trying to work with existing homeowners and making sure all of them are in the best position possible, like you suggested, Stephen, with the home repairs and with the quality of their mortgages before we start tinkering with the market in ways that could make it more difficult for them to do that. And I mean, just what I've learned, Elena, from talking to you and then following up. I think I posted an article from Pew Research about alternative financing, and the fact that it's so prevalent. 1 in 15 current borrowers use alternative financing according to their research, and it's much higher in the Hispanic community and then also in the Black community. So any minority community is going to be higher as well, but especially in the Hispanic community. So that's really interesting. So thank you so much for helping us learn more, not only about situations that we should be watching for, but also solutions to intervene in those situations. Take care, everybody.
Thank you.
Thank you so much.